Welcome everyone to the Hurley Investments Trade Findings and Adjustments for Tuesday evening, the 16th of April. I have a lot to go over today, and so let me just, in all honesty, if it's okay with you guys, I'm going to bash on the big boxes for just a little bit because I don't like the way they do business, plain and simple. Can someone please tell me what a fiduciary responsibility is? Because I've heard all kinds of comments and all kinds of understanding on what they are. So what is a fiduciary responsibility? Someone give me a guess. I've got legal responsibility. I've got the right to do good by the client. I've got protection of portfolios. That's interesting. Protection of confidential information. Yeah. In all honesty, they act in the best interest of the client. Ooh, I like that one. In all honesty, to put your client's interest above your own. That's it. That is a fiduciary responsibility right there. I kind of giggle because sometimes you hear a fiduciary responsibility doesn't allow me to show a portfolio. A fiduciary responsibility does not allow me to show you a trade. It does not allow me to front run a trade where I'm going to play, I want to place it after you guys do, or I'm going to place it first and you guys do it. There's a lot of misunderstandings on what a fiduciary responsibility is, and it gets used more often than not as an excuse not to do what a fiduciary should do. Now, it's funny. Are educations fiduciaries? Yes or no? Are educations fiduciaries? No. Is the administrator of your 401k a fiduciary? That's a trickier, harder one. No. Of course not. He just administrates it. In all honesty, is the person that puts you in a mutual fund a fiduciary? Yes, there you guys go. You guys are on it today. They're a fiduciary because in some way, shape, or form, they are licensed, bonded, and insured. I've got 3 states of license, but I do have exempt advisory abilities. If you do a broker check on me, been in the business for forever, the key point, actually I should just go to here. The key point is no disclosures, and I do like going through and saying, you can go through and you can't find any complaints against me. I've done what I've been supposed to do. I've got a couple law licenses, couple general industry. Everything I have is right here. Makes my job as a fiduciary pretty important to me. So with that said, let's just go ahead and call it the way I see it. As a fiduciary, I'm going to tell you, you better not ever pay for a financial plan. I know that goes against typical Wall Street advice, but I'm going to give you 3 reasons why you never pay for a fiduciary plan. I'm going to list them plain and simply for you. Number 1, a financial plan will never work due to a simple linear flaw in the program. What do I mean? I, as a fiduciary, have the right to charge you $2,500 to $5,000 to sometimes $10,000 to gather your information, to chunk it into a computer, and I can give you 60 to 100 pages, all bind it up, all that look really pretty. But the mistake I make is I'm going to give you a yearly average percent return. In which case, when I started in year 2000, I put my money in. My financial plan said, hey, I'd be up just with the money I put in. The 100K would be up 147.25% return over this 19-year period. Kevin, you should be happy. So, do you think I am going to be happy with my financial plan? And if I'm not going to be happy, tell me why not. Yes, that'd be a great return. You should be happy. Why? No, you should not be happy because the market doesn't average 7.75%. But it does average 7.75%. That is the average. Won't get the growth in reality. There's an interesting point. But they just printed me up 100 pages and charged me $5,000 for the sale of a business. And I could put this in Vanguard and be fine with the 7.7% average return. Kevin, it's like a flight plan. And every couple of years, you got to change it. Because as a fiduciary, that's what I do. You know what I hear? We suck at getting a flight plan where you need to go. So every couple of years, I need to churn your portfolio to book more profit and commissions for myself, knowing I'm going to get nowhere close to my pretty 60 to 100 pages, $5,000 little booklet I just charged you for. It pisses me off. Can you tell? Can you tell? It burns me to the core. The comment was made, you won't get the growth in reality. I really like that comment because here is the chart in reality over that same period of time. Linear founding, compounding interest. You hear fiduciaries spill all kinds of big words that, with all due respect, are bullshit. But no one talks about a real growth rate. And the real growth rate from 2000 looks like that. It looks nothing close to the beautiful little chart that was printed up in my, $4,400 financial plan because I sold a business and I had a chunk of change. That chart looks nothing like this chart. And in all reality, I think this was done at the end of last year. In all reality, over 19 years, if you put $250,000, well, if you put any money in 2000 and used your financial plan, you're at an 82.42% return. In 19 years, the market has not doubled in value. So what does your fiduciary tell you? Well, we tell you because we're working in your best interest, right? Hey, just put money in every month and it'll even out. It'll even out the ups and the downs. Well, with all due respect, I call BS again. All it does is put it in at different points, but the end result for earlier returns are always the same. Numbers don't lie, but how they're presented can be a significant difference in what you understand and what's real. Your presentation versus what really happens are two separate things. So, for all intents and purposes, it's amazing how a fiduciary, in my opinion, for the most part, for anyone that works for any of the big boxes out there, their job ends the moment they put you into something. Their job are money collectors, not money makers. And it bugs me. I'm going to cut and paste this, and I'm going to put it all in here for you. Because when it really comes down to it, even the fiduciaries who are there supposed to be working in your best interest, their job stops the moment your money's invested, because that's when they earn their commission. And from that point, it's the market's responsibility if something goes wrong. It's the market's fault if you're losing money. For all intents and purposes, it's your responsibility to suffer through huge downturns in the market. And that now comes to an interesting point. And I'm just going to title this My Biggest Mistake. But I'm first going to go over long puts. Put. Insurance on stock. I'm looking for more than that. I'm looking for if it's a responsibility and obligation. I want to know what that is. It is more than insurance on stock. Someone give me my technical definition on what is a long put. I'll help you out with the first word. Give me a second to type it in. It's kind of a long one. Wow. David is on it today. The right to sell a stock at a certain price. That is your strike price you choose. For a certain period of time. So, credit or debit trade? Credit or a debit trade? It is not an obligation. It's a debit trade, which your debit equals your risk, which equals your potential return of strike price down to 0. Example? Right. Oh, come on, Hurley. Well, actually, let's go through an example. I know I've got some stocks that have an earnings report. I've got some major earning reports that are coming up relatively quickly. Schlumberger. I've got a couple of Schlumberger in here. Right now, I have a covered call on Schlumberger that reports pretty soon here. Ooh, it's at 47.34. I really thought it would sell off. Today did not help me at all. But from what I bought at $42.70, I'm obligated to sell at 45. I took in a $64 credit. This might be a really good one to book, or if I was smart, to give myself a little cash in the pocket. Ports on the 18th. Dang it, they were towards the end. I could roll half of these. And I'm trying to roll for a break even. Buy some back. Paid 64. I'm looking for $2. So that's only a dollar credit. Need to go out a little bit farther. Let's see, in August. August is not coming up. That's not a bad one right there, but I really want to see August. So I'm going to pass on this one. I'll work on this one tomorrow. What's another one I can use? What's another one I can use? Well, let me go to Apple. I had Apple prepared up there. I've got 4,900 shares of Apple, and Apple has their earnings on the 30th. I am going to protect or start to protect today and tomorrow so that I don't have to go through a 3-day weekend, and I don't want to pay ridiculous prices for all intents and purposes, for time decay or volatility. Let's just put it that way. Right now, my stock position is trading at 199.25. I would like to be as close to at the money because that's the best bang for the buck. I would most likely do 200s. I would make sure they are on the 49 shares. And off I would go. I'd prepare for them that way. If you take a peek at a couple of these, well, actually, let's work the numbers. Apple trading at 199.25. I would purchase the May 31st, 19, 200 strike long puts for $7.85. I'm going to make it $7.75 because I'd get a little better price. It also makes my numbers work. Total cost basis, if I was to enter the trade today, 199.25 plus The long put cost of $7.75, which equals $107. What is the risk in the trade? What is the risk in that trade? Thank you. Risk in the trade is 207 minus the right to sell at 200, right? It's equal to $7. Or if you take $7 and you divide it by 200, 3.5% of total invested capital. I'm okay with that. I would not necessarily want to add a short call. I wouldn't want to cap that upside opportunity. Interesting point, a May 31st is out there 44 days, I believe, 43 days. More than that. Well, at 10, 11, 12, 13, it is 44 days. Where it gets me past my earnings event on the 30th, and I still will have 31 days before time decay, those last 2 weeks, really eat you out of house and home. So I'm giving myself 2 weeks for the stock to really fall down to a support level. If I was to look at Apple, pull it out to a year, falls big and comes back, comes up, pretty stagnant, up. Actually, it's moved quite nicely. We do have a fall here that was about 2 weeks. And then it continued. Actually, the continuation is about right there, but I think that was news in November. It definitely was. All market was falling then. Not necessarily an earnings event. Although it was an earnings. So I'm giving myself 2 weeks to make the decision. I could have run that one for 4, though. The way the stock looks, I like the way it looks. I like where it gives me the opportunity. I think that will allow me to make some of the downward movement on Apple. I put everything in as a group trade. I put it in as a group trade. It makes my job easy. And it gives me the ability to protect. Really, if I was to do a new trade today, if you were to ask me, hey, if you're going to do a new trade for your trade findings, I'm kind of partial to either Ford or to Freeport-McMoRan. I like Ford because I feel it has an opportunity to come back up to 12 from 939. That's almost a 25% movement. I really like Freeport-McMoRan because if I was to pull this one out, this one is a dollar figure. Over the last year, could definitely get to 18, if not, as I look at it, 1959. But that still is about a 33% upside movement. So they're both about the same. I would think you have more upside and opportunity for Freeport-McMoRan. So if I was looking at a trade right now, I would very easily get into Freeport, which reports on the 25th before the market opens. If I was looking for a trade, I would be buying Freeport. It's not going to let me do it. Why are you not letting me go? Let's go to options if I can do it there. In all honesty, I would be still using the May 31st. It's trading at 14.16. I'm okay with giving 16 cents of risk away. It's not letting me buy the stock, but I would do 400 shares, 4 contracts. Kind of a bugger that I can't preview this one or show you this one right now. I wonder, let me see if I can just, sometimes it does it. Maybe I need to log off and log back in. Still doesn't have a price. Oh, their system kind of bugs me. So let's do it by hand. The trade I would be in is a trade for earnings season. FCX at 400 shares. Buy to open at $14.16. Buy to open a $14 long put. May 31st, 19 for 71 cents. Total cost basis per share is equal to 14.16 plus your 71 cents, which equals 14.87. Total risk in trade is equal to 14.87 minus 14, which is equal to 87 cents. If I take, and I normally want it between 3 to 4% at the most, if I take 87 and divide it by 14.87, I've actually got 5.8% risk, come on, and total invested capital. Net, pretty easy to find out. 1487 times 400. It's only a $5,948 trade with a net risk of 0.87 times 400, $348. That seems like a decent trade to me. I normally don't like the 5.8% return, which means if I'm willing to cap myself to the upside, kind of like you saw in Slumberger. Slumberger would be like a 5.8% return in about 6 weeks. I really should just take the profits and run with that one. If I was willing to cap FCX at a 5% or higher, I wonder where I'd be out to. Let's see if we could lower this just a little bit. Being willing to sell my stock, I wonder if I could do a May 31st. There's no credit in it. No credit. If I went out to a June. A June 17 is only 16 cents. So you know what? I wouldn't cap myself on Freeport. And that kind of goes to my biggest mistake. Getting caught behind a soaring stock with a short call. NVIDIA. What price do you think I got called out on? Take a guess. What price do you think I got called out on NVIDIA? Take a guess, take a guess, take a guess. 100. Because right now it's trading at what? 165? The short answer is I wish I got called out at 100. But no, I did not. It is lower. What price do you think got called out on NVIDIA? Which right now is trading at 188.21. Oh yes, I got called out at $42 with an $18 covered call credit that only had maybe $2.50 of profit in it. Kevin, what happened? Well, it went from 60 to 90 overnight in an earnings event. It was overpriced. And a stock that pretty regularly lost half its value twice before it took off when I got into it way back in, 2015 or something like that. That's lost its value twice on these ridiculous runs up. What a bugger this stock is. Come on. Try that one more time. 5 years, get it out. So nothing like getting called out in January when it goes from a pretty neat 288 down to 130 something. You can find some other opportunities back here where literally it loses a third to 45% of its value time and time again. I just love this stupid stock. But it really bugs me when I get caught in between this run right here. That run killed me. from 69, opening at 79 and finishing at 88, that's where I got caught behind the 8 ball on NVIDIA. Where if I could have just held on to it, I might have had some pretty good drops. 35 down to 25. There's some other ones, 23 down to 18. 23 down to 19. Where's the other big ones? Here's some that are kind of buggers. 20 down to 16. 15 down to 10. It would have been awfully hard to lose 30, 35% just to buy and hold. I actually had a person ask me, and bless his heart, why didn't you just hold on? Why couldn't we have just been NVIDIA and not gotten called out? And the real answer is because real people can't see 30% of their portfolio disappear or 20% of their portfolio disappear in an up market. My worst mistake was getting capped on a short call and not buying it back for a pretty good loss when I had the opportunity. When you see something jump $30, it gets really hard to come up with 30 grand or more to buy back a covered call. And you can technically roll it out for forever, where you won't, for all intents and purposes, you will not get called out, but you're playing the earnings, the dividend, maybe a little bit of growth each year. Pretty cool to do, but not something that makes the kind of money that you want to. So, plain and simple, one of my biggest mistakes was getting caught behind NVIDIA and getting called out really January of last year after sitting in it for a year and a half with just nothing to do. So a lot of people ask me, why don't I use more short calls? Well, when you're in a bullish market, it maybe doesn't warrant yourself the opportunity to use a short call and cap yourself. If we run into a November time, yeah, I put some short calls on. But I hate getting capped out and having a stock run on me where mathematically it just makes no sense to take a big loss on a covered call hoping the stock continues to go higher. That is just, it just doesn't work. It just doesn't work that way. So there's my biggest mistake. Question came in earlier. Let me get the question answered really quickly. Obviously, I talked about turning a long put into a bull put or a put calendar spread after earnings if your stock goes up. They then ask, what about a long call after earnings? Well, in all honesty, if your stock goes up, you just let it run and you make a huge profit, right? If you had a long call and your stock goes down, then you start to do calendars. You don't necessarily turn it into a bear call, because if you had a long call into earnings, it should be a leap long call of some kind. 3 month poor man caller trades are just not the way you want to run a portfolio. You want to give your stock time to run. If it doesn't make it through this earnings, chances are in this bull market we'll see a run up eventually. Hence, we had one with Disney, right? Thank goodness I wasn't capping myself out of short calls on Disney. So, plain and simple, if you're using a long call or an exploding caller trade and your stock goes up, let that long call run. If your stock goes down, you start to short against it week after week to lower your cost basis to try to break even. We also had another question. Do I primarily run long puts? I do, and I usually try to get my risk in that 3.5% range or lower. Next is probably 3.5 to 4. which means I have run quite a few long puts slightly out of the money, not 2, 3, 4 strike prices out of the money, but if we have something that said, 197, I might run a 195 long put. I have been going out to weeklies where I'm trying not to do any more than a single dollar, where I want to be less than $1 of unprotected profit just to make my long puts a little bit cheaper. Any questions you guys have that I can answer for you? And if I was going to do a trade, Freeport McMoran, 1416, 400 shares. The reason why is it'll probably go down to 10 and lose 40%, in which case you can pick up another 100 shares with 400 shares relatively easy here. If there are no more questions, I would like to wish you guys a good evening. I will most likely get this posted sometime tomorrow. And with that said, you guys have a really good evening. And I look forward to seeing you Thursday morning, 10 a.m. Mountain Standard Time. We'll see if I can't find a spread trade or something to run at that point. Everyone have a wonderful evening. I'll talk with you then. Bye-bye.